Ranging markets are very profitable markets when it comes to forex trading or crypto trading. But then knowing how to trade them is the big problem here. So in today's video, I'm going to share with you how you can trade ranging markets profitably. What I mean by trading ranging market profitably is knowing when to do something and then doing it at that time. Simply means know what to do and then doing it at the right time. So there are two different type of ranging market. We'll have the ranging market that will trade within the range, and then we also have that one that will trade outside the range. So in this particular video, I'm going to break down every single thing to you. So I advise you watch this video to the very end so you get to learn every single thing you need to know to trade ranging market profitably. So with that already said, hello guys, welcome to my channel and welcome to Forex Trade. On this channel, I mainly focus on how you and I can make money trading crypto, forex, or stock, any sort of pair at all, any sort of market you are trading at all. On this channel, I mainly focus on tutorials that can help you come up with profitable strategies to actually trade these pairs. So without taking much of your time, if this is your first time here, don't forget to smash that subscribe button, like this video, and tell me what you feel down in the comment section. So with that already said, let's get straight on my laptop. Let me share with you a step-by-step guide on how you can trade ranging markets profitably. So hello guys, now that we're on my computer, let me break down to you everything you need to know about a ranging market and how you can trade it correctly. And at the end of this video, I'm going to give you some key information, some key rules that you should put in mind whenever you're trading a ranging market. So as you are watching this video, I advise you watch every part of this video and make sure you watch it to the very end to make sure that you get the best knowledge out of it. So now when it comes about to trading a ranging market, and for those of you who don't understand what a ranging market means, here is a general explanation for what a ranging market is. A ranging market in forex is a market where the price of a currency pair moves between a high and a low price range. This is also known as a choppy sideways or a flat market. So in most cases, everyone have names that they actually call a ranging market. So for me, in most cases, I call them the sideways market or the ranging market, because the market simply moves in between two brackets and then finds difficult to actually move out of that area. So that sort of market is known as a ranging market. So now that you've gotten the definition of the ranging market, the truth is that the definition will not be the main solution for you. So I'm going to take you over to my trading software as I show you how a ranging market actually appears, and then use the real life charts to actually shows you everything about how a ranging market portrays. So now let's get into trading view. Let me break that to you. So right now we are inside trading view. So for those of you who haven't or aren't really experienced about ranging markets, I'm going to make an illustration of how a ranging market appears, so that when we get onto using the main chart itself, you are not going to be confused when you see the market. So on this channel, I make sure that you get to understand every single thing I do. So I make sure that I break down everything into smaller pieces. So in most cases, a ranging market have what we call the high. So let me just increase the size. So it has this point called the high, and then it has another one which is known as the low. So for a ranging market to be fully formed, we need to get a consistent high and then a consistent low. So the market, after creating this consistent high and low, it tends to move in between this area and then finds difficulty to move out of it. So in most cases, here's how a ranging market appears. It goes, it comes, it might end halfway, and then it goes again, it comes. So in most cases, this is how a ranging market appears. The market moves in between this particular area and then finds difficulty to actually move out of the area. So whenever I encounter this sort of area, it's known as a ranging market. And the truth be told, this market happens to be one of the most profitable markets, but then it's very risky for beginners. That's why I'm not really fond of sharing it on my channel. So in general, this a ranging market appears in illustration. I use the word in illustration because the chart will not really print in this manner for you to easily see. So as a trader, whenever you get onto your chart and I see any sort of market like this, know that this is a ranging market. So in most cases, a ranging market do break out of the area, but then after breaking out, it falls in immediately. So at times you can see it break out of the area like this, but then after that breakout, it will fall in immediately, break out over here, fall in immediately. So when trading a ranging market are the market that actually requires the most sort of cautiousness or patience to actually trade. So now that you've seen the illustration of a ranging market, now I'm going to use some of my previous week trade as a clear example to you on how a ranging market appears and how you should actually trade it the smart way. So now when it comes over to trading a ranging market, we have two different styles of trading a ranging market. The first one is trading within the range, and then the second one is trading at a breakout level. So now all of these two have different rules that you need to implement when utilizing or trading those parts of system. So now I'm going to first of all touch on trading within the range, because in most cases most of us are literally going to trade between the range. Mostly those of you who are impatient, you are likely to trade between the range, and the trading between the range is the most riskiest kind of trade-off. But then when timed perfectly, you are still going to make decent amount of profit as compared to the amount you are going to risk for it. So now let's talk of trading a ranging market within the range. So now here is it. When it comes to trading market within the range, this is what I actually mean. So here is a clear ranging market, as you can see. You can see that the market is currently moving just within this rectangle that I've drawn here. I believe you can see this white line here. So this is the area whereby the market has actually been struggling to move recently. So in this sort of market, this is what we mean by trading within the range, because everything the market is doing is simply between this area here. And this is the hourly chart on GBP US, which is Great Britain pounds, and then US dollar. This is the 1 hour chart from the previous week. So now when it comes over to trading within the range in this sort of market, here is the first thing you need to know. Make sure that your trades are only placed at the key levels. So what I mean by key levels are simply these areas here. So here is a key level. So what I mean by key levels are these key areas here, which is the highest point in the market. These are the areas whereby you should be looking for opportunities to actually place an order in a ranging market. Anything apart of this area, then you shouldn't make any attempt of placing an order. So the reason why it's more advisable to place an order in a ranging market at a key level is because when you place orders at a key levels, you have an opportunity of using less amount and then aiming for a very higher profit. So for example, let me show you one benefit of it. So for example, if you had placed a buy order at this area here, because here you can clearly see a bullish so here you can clearly see a bullish reversal here. You can see this whether hammer or inverted hammer, whatever thing is called. I simply see it as a bullish rejection pattern. So whenever you see this sort of candles together, this shows that there's a high momentum that the market is actually going to buy. So whenever I see this sort of candles, I immediately place orders. So now here is a trick. When placing orders within the range in a ranging market, your stop loss shouldn't be at the key level here. Your stop loss should be way below the key level in the ranging system. So why should your stop loss be below it? The reason why your stop loss should be below some pips below the key level is that in case this market should pull back to this key level here, which is 60% possible, you wouldn't get out of the market immediately, but then it will still keep you in the market until it hits your take profit or finally break out to hit your stop loss. And then the main reason why you need to do that is because it helps manage your risks, meaning you are going to be risking less and then hoping to make more profit. But then when you decide to keep your stop loss in here, there's an 80% chance that the market will always get you out of the market before it will actually hit your take profit. So now when trading a ranging market within a range, your first point here is simply keep your stop loss out of the ranging system. So for this, I'm going to keep my stop loss below here. So now after keeping my stop loss below here, the next thing is that I'm going to look for a perfect 1:2. So what I mean by a perfect 1:2 is that I'll be aiming for a market movement within if I'm risking $100, then I should be making at least $200 in return. So that's what I'll be aiming for in the market. So now let's take a look at it here. So now after getting my stop loss like this, I've seen my entry trigger. Then I'm going to take this into until I see 1:2. So if you should take a look at it, you can see risk to reward ratio 1:2.37, and then this is perfectly okay by me. So whenever I'm trading and I get and I can see an opportunity whereby I'll be risking $100 to make $200, I'm always comfortable with it. So for this particular market, let's say this is what I'm risking right now. This simply means that my take profit will surely be hitted. And then another reason why this area was a good area is that if you should look at it here, this was the previous high the market created. So this shows that I've gotten a perfect risk to reward area in the market. So this is one benefit of trading ranging market at a key level. So when you are trading a ranging market, always wait for the market to pull back into the key areas, which is either the lowest point for you to place a buy order or the highest point in the market for you to place a sell order in the market. So now this is the first thing you need to know. And then the second one, which says that you shouldn't place any trade in the middle of nowhere is this. So for example, take a look at this market here. When the market pulled to this particular area here, so you probably be looking for opportunities to do one sort of orders here. So since the market pull here, you'll be looking for an opportunity to place a buy order. So for example, at this point here is a bullish, the only reason why I have to place a buy order is this bullish engulfing candlestick here. So for example, you place your entry there, your stop loss definitely, according to the rule, place it out of the box. You have your stop loss here, and then where is your take profit going to be at this point here? And this is a 1:1, which is to me 100% wrong trade, because take a look at your stop loss to your take profit. They are 100% equally matched. So meaning if you are risking $100, you are just hoping to make $100 back in the market. So meaning if you should take 10 trade and then lose 5, win 5, meaning you've made 0 profit in the market. But then if I should take 10 trade with this other system and then lose 5 and then win 5, simply means that I'm still well ahead in profit in the market. So this is the number one benefit why you should always look for opportunities to trade at only key levels when trading within the range. So if you are trading a ranging market, here's the first thing you need to note. Don't place an order when the market is in the middle of the range. Always wait for the market to come down to key levels before you place your orders. Until the market drops down to key levels, make sure you don't place any sort of order. So in case you don't understand what key levels means in a ranging market, then I'll be linking to one of my videos that is talking majorly about market structures, identifying key levels, and how to draw your key levels to make sure that you are making the right trades at the right time. So that video will be linked down in this description as well. So now, once the market gets to a key level, doesn't necessarily mean you should place an order. Consider the candlestick that is showing at the key level. So for example, take a look at this one here. If I want to place a buy order, before I will make any attempt to place a buy order, then the candle that is giving me the hope to place that buy order must be a bullish candle. If it's a bearish candle at a key support area, I'm not still going to buy the market. Why won't I buy the market? Simply because the candle there is telling me that there are sellers in the market, meaning I should stay out since I want to be a buyer, because my single one trade cannot change the direction of the market. But then if I should see a bullish candle there, a bullish candle with a long wick rejection, that simply shows that the sellers are weak in the market, meaning the buyers have more power in the market. So I should be looking for an opportunity to buy with them immediately. So for security reasons, I'm going to buy with them immediately that bullish candle prints, and then I'll keep my stop loss on pips below to make sure that in case sellers should take over again, my losses should be less than whatever amount I was planning to make. So now this is the first point in actually trading a ranging market. Is simply trading within the range. And then the second one we'll have is simply trading outside the range in a ranging market. So what do I mean by trading outside the range? I know you've probably heard of breakouts, pullbacks, and then the rest. Well, those sort of markets also get formed from a ranging market. And then when it comes to trading breakouts in a ranging market, there seems to be the most profitable system of actually trading a ranging market. The reason why I see them as the most profitable ones because they give you more chance to make more money. However, when timed wrongly, you will make more losses. So I'm going to show you how to time pullbacks, breakouts very fast, and then place the right entries in breakout market to make sure that you make more profit instead of making more losses. So now let's move over to the chapter 2 where I'll show you how you can trade breakouts in a ranging market. So hello guys, here is the second system of trading a ranging market, which is known as trading the breakout. So when it comes to trading the breakout, it's one of the most profitable. Like, it's very easy for you to actually hit whatever take profit you are setting. But then there's one problem with it. You need a lot of patience to actually make more money from trading breakout, because that particular breakout you are waiting for might not come out today, tomorrow, or like for quite a long time. But then the day it eventually breaks out and then you wait for the right moment to place your order, trust me, there is a huge profit for you to make within few hours. So now let me give you a typical example. So here is a ranging market, as I already showed you. Take a look at this. You can see this is the pair between GBP JPY, which is one of my favorite pair, since I started forex trading back in 2021. So GBP has been my favorite per year in year out, because despite its poor performance recently this year, I still love it. This is because I've traded so many times and I've got to understand how it operates. So I do exactly the same way when trading it. So now let's take a look at what actually happened in this market. So you can see that this market has quite been ranging for a long time right now. You see, so you can see with all this ranging, and then it eventually broke out. Now here is one thing you need to see in this market. You can see that whilst this market was ranging, something was being created in this market. Take a look at it here. Look, you see, whilst the market is ranging, it was gradually creating swing lows. But this doesn't mean whenever you see swing lows like this, you should jump into the market. It might reverse to become an uptrend if care is not taken. So I'm just trying to highlight something to you. You can see that the market created a swing low. So this shows that the market was creating more pressure and then leading towards the support area. So the support area is simply this low area here in the market. So this area in the market is known as the support area. So in case you don't know about support and resistance, you can watch my videos on support and resistance, which should better explain to you what support and resistance actually means. So here is known as a support area. So now whilst the market was approaching here, so I had two thoughts in my mind. I'm going to be honest with you. The first one is that I was waiting for this market to actually come back here, break out of here, come back to retest, and then show me a sign of rejection here. Then I'm going to buy. But in case it doesn't print this, then I'll be looking for the other way around, which is this market breaking out of here, coming back, and then give me a sign of rejection. Then I was going to sell. So I had these two plans in mind, and then one of them actually got triggered. So now let's take a look at how this one actually got triggered. You can see, let me get rid of my drawings from it. So the moment the market break out, here is a big warning to most of you. So in case you want to trade breakouts, be very cautious of this thing. Don't place any sort of orders the moment the market broke out. The reason why you shouldn't do this is that the first breakout might be a fake out. So a breakout is only confirmed when it has successfully retested and then printed a sign of rejection. So for example, let me show you something here. So if you should look at it over here right now, you can see there was a breakout here. Here was a breakout, but what did the market do immediately broke out? It went back in again. This is why you don't have to trade any sort of breakout until a rejection pattern has been printed in that particular time frame you are trading. So for me, recently in 2024, I'm going to be honest with you, I found love in actually analyzing on the 4 hours and then looking for my entry opportunities on the 30 minutes. Due to how the market has been moving, I'm now more of focus on the 4 hours and then the 30 minutes to get good opportunities to actually trade. And then this past week, which is the final week of February, was really a great week because I was able to come up, like I was able to secure a good amount of pips, which is over 100 pips on various markets from just minus capping within a week. And that was really cool because I don't trade a lot during the week. I mainly trade from Tuesdays to Thursdays. I don't trade on Fridays. I only trade Tuesday, Wednesdays, and Thursdays. And I'm a day trader, meaning I was looking for minor moves to get my profit, and I was able to get over 100 pips, and that was a great add-on. So that aside, let's come back to our particular trade here. So now let's take a look at this particular market here and what I did right and what you should also do when trading a ranging market on a breakout. So now when trading a breakout, your first aim is that wait for the market to break out of the area in which it's actually ranging. And if you take a look at this here is the area where the ranging has been, and then the moment it broke out, I waited for one thing which is known as the pullback. So here was the pullback here. So take a look at it. It broke out with this candle up to this extent, and then immediately it broke out. You can see that the market from this breakout, like it pulls back to this area again, and this is what I known as the retest. So immediately this pullback happened, I'm not still going to place any sort of order. The reason why I won't place any sort of order is that this pullback might mean that the bulls have taken charge of the market from the sellers again, meaning it's possible, it's a possible uptrend. But then what I saw next was that the market printed this bearish rejection. So now let me zoom in to actually show you the bearish rejection I'm talking about. So let me get the zoom to.
Oh, that's horrible. So here is a bearish rejection. If you should look closely, you can see that immediately the market pulls back, you can see that there was a full force from the sellers to drag the market back downwards. So immediately this market got to this extent, I placed my short order immediately. So the reason why I placed my short order immediately is that I don't want to say, oh, I was waiting, then the market reversed against me. No. One thing I do is that whenever I see my entry trigger, my entry pattern being triggered, I place my order immediately. If the market gets me out, let it get me out. But if it keeps me in, all praise to God. So that's simply what I do in the market. Like once my entry symbol has been seen, I place my order with immediate effect to avoid saying that, oh, I saw my entry pattern, but I was waiting for something that I don't know. So it's either I get in and lose or I get in and win. That's just my only plan when I'm placing my order. So like I said, after the breakout and the pullback and I place my order immediately, the market pulls back down again, which gives me this area that the market was actually going to sell. So you can see that the market sold from here up to this mid level here. So it sold up to this level here, and then what did it do next? It gave this bullish engulfing candlestick, and then quickly the market reversed back into my area again. Yes, the truth is that I didn't see the market during this reversing. Based on how I trade, the moment I see this sort of reversal, this sort of bullish reversal, I normally do leave the market immediately. That's one thing I'm going to be honest with you. When I place a trade and then I see some sort of heavy reversals, I'm likely to get out of the market unless I hope a pattern is going to be formed. And then one thing I was thankful for is that when this sort of reversal happened, I wasn't here. So since I wasn't around, I didn't see the particular reversal. When I came to meet the market was that I was in a tiny loss here. So I was already in my loss zone. And when I'm in my loss zone, I don't close trade. Because when I enter the market, I set a clear stop loss. So when I come and meet my chart that I'm in a loss zone, I don't bother myself closing the trade. I simply wait for it to do whatever thing that pleases the market. So until I get back into profit, let my stop loss hit. That is simply my ideal. But once I'm into profit and I see any sort of strong reversals, I do get out of the market to avoid waiting for days before getting back into profit again. But if I should meet my trade in a loss position, I let it go and hit my stop loss or probably reverse back into my progress. So one thing you can notice here is that after the market reversed into this area again, what did you see here? In this area, you can see it printed another big bullish candlestick, which actually gave you the momentum to come and hit my take profit. So here was my trade that I already have here. That's why I said I'm using it as an example for you in this particular video. So you can see this is simply what happens when you're trading a breakout. When trading a breakout, first of all, wait for the market to break out of the key areas where it's ranging. After breaking out of the area, secondly, wait for the market to pull back for a retest. And then once it pulls back and it gives you any rejection, don't wait for anything again. Place your order immediately. Unless that is not the entry pattern you personally use. If that is the entry pattern you personally trade, place your order. But if that is not the entry pattern, then you can let it go. So for me, that was the entry pattern I personally trade, so which is that kangaroo tail, generally known. Immediately I cited it, I was left with no option but actually placing my order. So immediately I placed my order, I leave the rest to the market to actually do whatever thing that pleases the market. So immediately this thing happened, I had to let it slide until I went back into loss, and then finally my take profit was heated. So now here's one thing you need to learn from this particular trade when trading a breakout. You can see I did not put my stop loss at this point here. Now you'll be wondering, why didn't I put my stop loss here to minimize my loss in case the market should go against me? The reason why I did not keep my stop loss here is that I was 90% sure that the market will come and retest this area here, this key level here, which is the support area in the market. I was 90% sure the market was coming here. So I did not keep my stop loss, but then I keep my stop loss inside the box. So the reason why I keep it inside the box was to give a little room from the key level and my stop loss. So in case the market should get into the box, let it get me out. So when it gets me out, then I'll be looking for another sell opportunity or a buy opportunity again. So this is how I simply trade. When the market gets me out, I try seeing if I'll get any other opportunity in the market. If I don't see any opportunities, I let it go. But when there is an opportunity, I'll trade it. So for example, take a look at this market. If my stop loss was here and then it got heated with this candlestick here, I'll be looking for an opportunity to enter again, and immediately I see this big bearish candle overtaking this bullish candle, I'll still go in for a sell again. That's simply how I trade. As long as I see my entry trigger being my entry pattern being triggered and it falls in line with the market structure, I trade it immediately. So when trading a breakout, always make sure that your stop loss is above the retest point, which is the point the market went to retest. And for this one, here is where the market went to retest here. You can see my stop loss was some pips above it. This means that I'm a bit safe in the market. So anything above that, the market structure has been violated, so get me out of the market. So now this is simply the knowledge in trading breakouts, and then when trading ranging market, whether trading within the range or trading at the breakout. The first one is simply look for buy entries at a support area. So that is the first rule. Look for buy entries at a support area. Secondly, look for sell entries at a resistance area. Look for sell opportunities at a resistance area. These two applies when you are trading within the range. And then thirdly, don't place an order when the market is within the ranging box. So within the box, make sure not to place any sort of order at all. Now moving on to breakout. So if you are trading a ranging market breakout, here are the things to put in mind. The first one is simply don't place an order the moment the breakout actually occurs. The reason is that the market might pull back into the box again and then making that first breakout a false breakout. Secondly, when placing an order, make sure that your take profit is up to maybe 1:5 or 1:2 of your risks. Don't place an order of a 1:1. It's not really friendly at all based on my own trading system. Thirdly, when your entry trigger when your entry pattern got triggered, place your order immediately. Don't be in a haste. Don't be waiting for any opportunity that let me wait for the next candle. The next candle might be the candle that will lead to your take profit immediately. So place your order once you see your entry pattern aligns with the market structure. So now these are simply the rules you apply when trading this market. This market is simply the easiest sort of market to trade. Like, I prefer trading ranging markets on a breakout point than even trading uptrends and downtrend. The reason is that once a market has ranged and finally broken, that simply means that there's a more momentum on that direction, meaning any trade on that direction is going to be a 70% winner. The 30% is your chance of you losing it, which is also possible. So this already said, hope you've learned how you can actually trade a ranging market, whether trading within the box or outside the box. So hope you find this video helpful. Don't forget to smash that subscribe button, like this video, and also share it with your fellow traders as well. So that already said, have a nice day. Bye.